Welcome to Rich Tribe.
So think about your situation right now. You work hard, you finally get that promotion, you're making good money. So why on earth does your bank account say you're broke? Seriously, if your income has gone up over the last 5 years, but your savings haven't really budged, you are definitely not alone. Today, we're uncovering exactly why most people never build wealth, and more importantly, how you can actually break that cycle.
Let's start with Section 1. Income does not equal wealth.
We really need to dive straight into this because this concept is the foundation for everything else we're going to talk about. We have to completely separate the idea of earning a lot of money from actually keeping it. High income, that just means you have the cash flow to live really well today. High net worth means you have wealth accumulated for tomorrow. At the end of the day, wealth is what is accumulated, not what is spent.
Okay, but hold on a second. If someone is out there making a six-figure salary, shouldn't financial security just be automatic? I mean, if you're making that much, you're basically wealthy, right?
See, that is exactly the trap. A person making a high income who spends every last dime to maintain a lavish lifestyle isn't getting wealthier. They're just living well. Without a coordinated strategy, a big paycheck alone just doesn't solve life's financial complexities.
Just look at how deep this trap really goes. 4.6%. That is the average U.S. savings rate as of our recent checks. It's a pretty paltry number, and it proves a very sobering reality. Regardless of income, the vast majority of earners are literally living paycheck to paycheck simply because they lack a coordinated wealth-building strategy.
Moving on to Section 2, compounding versus inflation. All right, so if people are saving such a tiny fraction of their income, what is silently eating away at it? Like, what actually happens to that little bit of money they do manage to save?
Well, that brings us to the two invisible forces dictating your financial future: compounding and inflation. Simply put, think of compounding as a massive tailwind that pushes your wealth forward. Inflation, on the other hand, acts as a relentless headwind that slows it down and slowly destroys your purchasing power. Okay, tailwinds and headwinds sound nice in theory, but let's make this real. Show me the math. What does this actually look like over a long period of time?
Let's look at how this builds over decades. Imagine you have an initial 10 lakh rupees. If you have that money compounding at 12%, after 20 years, it absolutely explodes to 96.5 lakh. That is the incredible exponential tailwind at work. But if you just leave that same money sitting in a cash account, a 6% inflation headwind completely ravages it. You're left with the purchasing power of just 3.1 lakh.
Wow, no way! So over 20 years, choosing not to invest means your money literally loses more than 2/3 of its value. That headwind doesn't just slow you down, it completely throws you backward.
That brings us to Section 3, the psychology of spending.
So if the math is that clear, why don't people just invest? Well, because a huge part of this tug of war lives entirely inside your own mind. The first psychological barrier is loss aversion. This is the very real phenomenon where humans feel the sting of losing money much more intensely than the joy of gaining it. It literally freezes people. They keep their money parked in a low-yield savings account because they are absolutely terrified the market will drop.
I kind of get that, though. I mean, the market is super volatile. Isn't investing in the stock market basically just a giant casino?
It only feels like gambling if you let your emotions drive your decisions. Just look at the historical data. A 20-year analysis showed that while the S&P 500 averaged a solid 7.2% annualized return, the average retail investor earned a terrible 2.6%. Why? Because of emotion. Loss aversion makes people panic and sell when the market drops, and then they buy high out of the fear of missing out. Impulsive, emotional investing absolutely destroys long-term compounding.
Then, on the spending side of things, we have hedonic adaptation. This is our psychological tendency to rapidly adjust to improved circumstances. There was this famous 1978 study on lottery winners showing that their happiness reset to roughly where it started just months after their huge windfall. The initial thrill fades, but those expensive new lifestyle costs, they stick around.
That makes total sense. It's like realizing that a $50,000 watch doesn't actually make you any happier than a $500 watch. It just tells the exact same time, but now you have way less money in the bank.
And that takes us to Section 4, beware of lifestyle creep. Knowing all that psychology, why does it feel so incredibly impossible to avoid spending more when you get a promotion? It feels like the money just walks right out the front door. Plus, honestly, hard work creates a sense of entitlement. If I grind and put in 60 hours this week, don't I deserve a nice dinner out or a better vacation? You do, but that right there is the danger of the "I deserve this" trap. Lifestyle creep happens in lockstep with your income. That $6 Friday coffee quietly becomes a daily entitlement. You upgrade your membership to the boutique gym. You shift your holidays to expensive Fiji resorts. Each upgrade feels totally earned in the moment, but cumulatively, these subtle everyday shifts are secretly sabotaging your wealth accumulation.
So, the absolutely crucial point is this quote right here. The gap between income and spending is where wealth is built. You have to meticulously track your actual spending to protect that gap. And frankly, you have to choose your social circle carefully. Because if your social life constantly revolves around expensive restaurants and keeping up with the Joneses, you will drain that wealth-building gap straight to zero.
Section 5. Overcoming Systemic Wealth Gaps. Okay, I definitely hear you on the personal choices front. But we have to be real here for a second. Sometimes the system itself is what's actively holding people back. You are absolutely correct, and it's really important we look at this data neutrally. When we examine the historical top 10% wealth share in the United States, we see immense concentration. This data clearly anchors the reality of inequality and shows us very plainly that the playing field hasn't always been level.
There are well-documented systemic barriers that actively impede wealth accumulation, particularly for minority households. We're talking about things like historical discrimination, such as redlining, ongoing wage disparities, limited access to business capital, and of course, the crushing weight of student loan debt.
Right, and those are massive institutional headwinds. If someone is facing all of that at once, how on earth do they as an individual fight back and actually build any net worth?
Education is honestly one of the most powerful weapons we have against these systemic gaps. Research has explicitly linked higher financial literacy to better investment returns, showing that financially literate individuals earn a 130 basis point premium on their portfolios. Truly understanding how money works empowers individuals to navigate and overcome these profound disparities. Speaking of empowering yourself with financial education, if you're finding this explainer valuable, please subscribe to Rich Tribe channel. Like, comment, and share. Your support is what helps us bring you more of these deep dives. All right, now let's finally unveil the step-by-step strategy for actually becoming wealthy.
Section 6. The Millionaire Next Door.
All right, we've covered the psychology, we did the math, we talked about the systemic hurdles. So what's the bottom line? How do we actually break the cycle and join the wealthy? First, let's shatter a major myth right now. What's fascinating is this number, 80%. Over 80% of America's millionaires are first generation.
Wait, really? 80%? So you're saying they didn't just inherit trust funds or win the lottery?
Exactly. They didn't inherit it at all. They built it. And they built it using a very specific framework.
Here is a practical, actionable starting point, the 50-30-20 Wealth Blueprint. You allocate 50% of your income strictly to needs, your housing, your groceries, utilities. Then 30% goes to wants, entertainment, hobbies, going out. And a non-negotiable 20% is immediately funneled into savings and aggressive debt repayment, specifically targeting any high-interest debt that's over 6%. Doing this forces you to live below your means and ensures consistent, disciplined investing.
But beyond just the budget, it's a mindset shift. Based on the findings in The Millionaire Next Door, the truly wealthy share some very consistent traits. They live conservatively, well below their means, they are wildly efficient with how they allocate both their time and their money, and most importantly, they value financial independence vastly more than displaying their social status. Real wealth usually just looks like a standard, reliable car parked in a completely unremarkable neighborhood.
So we'll leave you with this final provocative thought to chew on. If your income keeps rising, but your actual wealth isn't, who are you really working for? Are you working to fund the profit margins of luxury brands, high-end restaurants, and credit card companies? Or are you funding your own freedom? It is time to stop funding a lifestyle and start funding your future.